Okay, here's one more problem involving notes receivable. And this particular problem happens to span two accounting periods. So you can see here it says Mega Hits accepts $15,000, 4% interest, 60-day note in payment of a past due account receivable. So again, we're accepting a notes receivable in place of an accounts receivable. This happens on November 18th. It's a 60-day note. So when the customer pays us, it's actually going to be next year, right? When the note matures, it's going to be next year. So what we have to do at the financial statement date at December 31st, before we prepare our financial statements, we have to accrue any interest that we've earned. Simply from the passing of time, we've earned interest from November 18th to December 31st, even though the customer isn't going to pay us until sometime in January. Remember, we learned back in chapter 4 that we have to accrue on our books any revenue that we've earned, even if the customer hasn't paid us yet. And so I have an example. Let me pull up my Excel spreadsheet here so I can show you how to calculate how much interest you've earned at the financial statement date. And so on this particular problem, it says on October 21st, Excel Inc. accepts a $10,600 8% 120-day note in payment of a customer's past due accounts receivable. So again, the first thing you have to do is figure out when is the customer going to pay us. And it's a 120-day note this time. Remember last time we had a 90-day note. And so again, it's October was the date of the note. So you have to take the 31 days that there are in October, subtract out the note date, and that's how many days you count for October. So 31 minus 21, because August 21st was the date the note was signed. That gives me 10 days to account for October. And then you just keep adding down the rest of the months until you get to 120 days. So November has 30 days. I add all of those. December has 31 days. So I add all of those. January has 31 days. And so now I'm up to 102. With February, I know sometimes February has a leap year. Unless the problem tells you that it is a leap year, you use 28 days for February. Okay, don't use 29 because you know it might be a leap year. If the problem doesn't say it's a leap year, you assume it's a normal year, and so you use 28 days here for February. So if I plug in 28, you can see I'm over my number of days. I need to get exactly up to 120. And so I can see here, right, that it's 10 days more than I need. So I plug in here 18 days for February, and that gives me exactly 120. So this note is going to mature on February 18th. So I can type in here, my maturity date is February 18th. That's when the customer is going to pay us this notes receivable, right? They're going to pay us the $10,600 plus the 8% that they owe us. However, so let's go ahead and record October 21st receiving this note. Again, we are taking this accounts receivable off our books, right? It was a past due account. They can no longer pay us within 30 days, and so we've agreed to extend it out 120 more days, but we're going to expect some interest. So now instead of having an account receivable, now we have a note receivable. So we have to put the note receivable on our books, and since notes receivable is an asset, you have to debit that to increase it, $10,600. That's what they owe us, the principal amount. And I need to take that accounts receivable off of my books. And accounts receivable is also an asset. But now I'm trying to decrease that because I have that $10,600 accounts receivable there that we're now substituting for the notes receivable. So I need to decrease my accounts receivable with a credit. So that's what happens on the day that the note is signed. You take that accounts receivable off the books with the credit. You put the notes receivable on the books with the debit. All right, so then the next part of this problem asks you to record the adjusting journal entry required at the financial statement date, which is December 31st, to accrue the interest that's been earned but not received at that date. Because what's going to happen is on February 18th, right, that's the maturity date, this customer is going to pay us the $10,600 plus the 8% for the whole 120 days. However, we have to prepare financial statements at December 31st. And simply because time has passed from October 21st to December 31st, we've earned this many days worth of interest. And we can add up how many days that is, right? 10 plus 30 would give me 40, plus 31 gives me 71. So I've got 71 days of interest that I've earned from October 1 October 21st to December 31st. And again, we learned in a prior chapter that any revenue we've earned, whether we've gotten paid for it or not, has to be accrued on our financial statements before we produce them. And typically, most companies produce a financial statement at the end of the year. And so that's why at December 31st, we're having to accrue this interest. So we're not going to accrue the whole 120 days worth of interest at December 31st because we haven't earned all 120 days worth yet. We've only earned for the amount of time that's already passed. We have not earned the January and February days yet. So what happens at December 31st? We use this formula, principal times rate times time, to calculate how much interest we've earned in these 71 days. So our principal is $10,600. I'm just going to plug that into our formula here. Our rate was 8% this time. And our time we just calculated was 71 days. That's the amount that I've earned for October, November, and December, because right now we're sitting at December 31st, and I'm trying to figure out how much of this 120 days worth of interest I've accrued, and it's 71 days we have earned. So 71 divided by 360, because remember, in finance, we always use 360 days for a year and not 365. And because this rate is expressed as an annual interest rate, time has to also be expressed as an annual amount. So then I just have to do the math here. Let me pull up my calculator. 71 divided by 360 times 8%, and when you convert that to a decimal, it's 0.08, times 10,600. So $167.24. That's what we came up with. Okay. So what do I need to debit and what do I need to credit? Well, I've earned this revenue, right? Even though they haven't paid me for it yet, I've earned it simply from the passing of time. So I have to record interest revenue. And anytime a customer owes me money, it's always some sort of receivable, right? I have the right to receive that amount in the future. If it's accounts receivable and we're giving them 30 days to pay without interest, that's accounts receivable. If they signed a note and there's going to be interest involved, that's notes receivable. The interest that they owe us then is going to be interest receivable. So I'm going to debit interest receivable. And again, this is an asset. I have the right to collect that sometime in the future. The customer is going to pay us on February 18th. If you remember correctly, so that's $167.24. And I've got to recognize that revenue, interest revenue, $167.24. So revenue accounts get increased with a credit, and so when I credit that increases my revenue, and asset accounts get increased with a debit, and so when I record that increases my assets on my balance sheet. And it shows that the customer now owes us $10,600 in principal and $167.24 in interest for those 71 days that we've earned thus far. Okay, so that's the journal entry that you would make on December 31st to accrue the interest that you've earned but have not received yet.